If there's one thing that we have learned over the past year or two is that our stocks do not exist in a bubble. No matter how good the fundamentals of the company, economic factors can have a huge impact on your returns, at least in the short term. And especially in a situation like right now, when we've seen a rapid rise in inflation and a rapid rise in interest rates to combat it. Apart from the initial pain, this cycle that we are going through right now also presents some opportunities. I really like this diagram, which shows you which sectors theoretically should be performing well in times of either rising or falling interest or inflation rates. On your y-axis here you have inflation, whether it is rising or falling, and then on the x-axis you have your interest rates, whether they are falling or rising. And this gives us 4 different quadrants with different economic conditions which can suit certain sectors. Now it all sounds great in theory, but has this actually come to pass? Because we are about halfway through this cycle, so we can actually put this to the test and see if these industries have actually performed well when they were expected to. Because in our lifetime we're probably going to see a couple of these cycles, and it's good to be at least prepared and ready to try and take some bit of advantage of them. So we are going to kick off our analysis in the top left hand corner here, when inflation initially started to rise and interest rates are falling. But in reality, our interest rates at the start of the cycle were pretty much close to zero, so they didn't have any further to fall. In this time period, we were expecting real estate and retail to have performed well. And it makes a lot of sense really when you think about it, because if you have real estate and the price of everything is rising, but the rates you can borrow funds at are next to zero or falling, then you're obviously going to be doing quite well if you own real estate. And the same can be said for retail, and even though some of their product input costs will be rising, they can increase their profit margin by passing this on plus a bit extra to the customer. We really started to enter into this first quadrant in 2021. As you can see, this is the US inflation rates from 2013 to 2023. In the years leading up here, inflation was in line with their expectations. Most economies want their inflation rate to be around 2% per year, so it was pretty much perfect in the years leading up to COVID. Until we then had to print trillions and trillions to prop up the economy during the pandemic. And we still remained in that first quadrant of just high inflation but low interest rates up until around March 2022. When the Fed, which were one of the first central banks around the world to start increasing their rates, they started rising them rapidly from about March 2022 onwards. Initially, the theory holds up really well when we start looking back at the performance of the different sectors around that time. So if we look at a REITs, for example, this is a REITs index, and then for the year of 2021, and this FTSE REITs index had an absolute booming year. Just non-stop growth for the whole year. Similarly, if we look back at retail, this is a general retailers index. In the year of 2021, there was another absolute booming year where the index saw huge growth of close to about 30%. So this diagram has been on the money so far, but as we moved then into around March 2022, when interest rates started to rise, this theoretically should have started to favour the likes of insurance companies, banks, energy companies, commodity producers and gold miners. And they're almost starting to top out right now, but our inflation rate definitely topped out around December 2022 and started to fall in the first couple of months of this year. So let's check out how a couple of these sectors did over that time period. If we start looking back at 2022 in total, the 10 best performing stocks on the S&P 500 were pretty much all oil and energy companies. Some of these companies had absolutely massive returns of between 70 to 119% in one calendar year, which is crazy. However, if we look at bank stocks performance over 2022, it's not such a rosy picture, as say the banks actually performed worse than the S&P 500 overall. As we all know, there have been a few other factors at play that have affected banks' performance. We have seen a couple of regional banks fail in the US, particularly ones that were overexposed to the tech sector. Along with that, there has been a huge drop off in mergers and acquisitions over the last year. As you can see from this table, some of these banks make a huge portion of their fees from M&A. So if you look at the likes of JP Morgan, make 38% of their fees from M&A, Goldman Sachs over 54%, Bank of America 21%, Morgan Stanley 50%. In the first 3 months of 2023, the fees earned from M&A activity was down 38% compared to the first 3 months of 2022. So that has been holding back a good couple of banks that would usually be making hay now with the higher interest rates. But things are now starting to look good for the banks. We have seen a good few positive earnings reports in recent weeks, and let's have a look at some of the returns over the last year for some popular banks. If you're looking at HSBC, they're up 20% over the last year. Two Irish banks are doing really well, so Bank of Ireland up 53%, AIB up 60%, then Goldman Sachs is up 19%, Morgan Stanley up nearly 15%, Deutsche Bank up around 6%, a bit lower. Then we have JP Morgan up 22%, and Bank of America actually down nearly 9% year on year. There still seems to be a good bit of room for banks to grow over the short term, as interest rates rose at such a fast pace across the world that they really haven't had the time to pass on everything to the customer. So I wouldn't be surprised to see the profits swell at some of these banks over the next year or two. Another sector that was expected to perform very well in a time of high inflation and high interest rates were gold miners. So this chart is showing you the VanEck Gold Miners ETF and the performance over the last 3 years. So initially, when we started to kind of come into a period of high inflation, there was a real big spike in the price of gold, and naturally enough, the spike also translated into this gold miners ETF as well. So we saw a very short but very sharp burst and a decent return for a couple of months, but as we see from then on, when the interest rates actually started to rise as well, actually the price of gold dropped back significantly, and you wouldn't have had made much of a return by putting all your eggs into gold miners over the past year. Also, another factor that was in play at this time was the Russian invasion came in late February 2022. So this would have pumped up the gold price as well. So this is probably the first sector on our diagram where we haven't seen the theory actually translate into real life. You wouldn't have been too happy with your investment if you had stuck it into this gold miners ETF. So next up, what about insurance companies? Well, it's kind of a similar enough story for insurance companies. Over the last year, we've only really seen modest enough growth. We've seen about a 6% return on this S&P 500 insurance industry group index. That's barely over the risk-free rate of return at the moment, so not really great. In theory, these insurance companies should be holding a lot of safe debt to back up all of their insurance products. Because interest rates rose so fast over last year, maybe we haven't seen the full benefit of this translate into the share prices of these insurance companies just yet. It will be interesting to see how this index plays out over the next 6 to 12 months. So now we've moved out of quadrant number 2 and we're into quadrant 3 here, and this is where interest rates are rising and inflation is falling. So that's where we are right now. We've kind of been here since around January 2023, and in this environment, what is expected to happen is semiconductors are meant to perform well, and also healthcare stocks, which is a broad enough category which includes the likes of, say, pharma, for example. Well, if we just look at markets over the last month, there has been an absolute clear winner, and that has been semiconductors, up 22% compared to the overall US market of around 4.5%. While there are other factors at play here, such as a bit of momentum around the whole AI side of things, it is interesting to see that semiconductors are leading the way. Although semiconductors have been booming, the other sector that was expected to perform well was health, and we haven't really seen that transpire at all. If we look at this S&P 500 healthcare index, for example, over the last 6 months we've seen a bit of volatility. It's been up and down, it's been sideways, but there hasn't been any clear gains to be had here so far. In theory, what should have been happening, because of the increased volatility that has been caused by rising interest rates, it was expected that more money would be flowing towards more safer bets in terms of your likes of healthcare and utilities, but that really hasn't happened yet. It could possibly still happen, but it's not what we've seen happen so far. We've actually seen a huge uptick in the likes of tech stocks again, which was probably a little bit ahead of when it was expected to happen. So it's hard to know how long really we are going to end up staying in this quadrant. It depends really on how sticky inflation is. It does look like we are close to the top of our interest rates, but we should eventually start to move towards this last segment here where interest rates are falling and so is inflation. And in that type of environment, we would expect tech stocks, utilities and consumer staples to flourish. But as we have seen already, tech stocks have kind of taken an early lead even before interest rates have started to fall. The same hasn't been true for consumer staples and utilities, which have been flatlining over the past year. So there could be potential future opportunities here over the next year or two, but we'll have to wait and see how that plays out. So what do you think of this diagram? Is it a useful guide? Is there any industries or sectors that we're potentially missing here? Please let me know your thoughts down in the comment section. I hope you found this video interesting. If you did, I would really appreciate it if you could drop a like on the video and subscribe to my channel as well. And hopefully I will see you guys again in the next one.